Welcome to the video lecture entitled Introduction to Taxes. This first video lecture ties in with Module 1, and the purpose of this lecture is to just go over some basic terminology and some basic foundation material behind the income tax itself. First thing I want to talk about is a little bit about the history of income tax and two major moments in that history. First of all, in 1895, there was a Supreme Court decision that surprisingly actually determined that a federal income tax would be against the Constitution. It would be unconstitutional. And of course, we know that the highest law in the land is the U.S. Constitution, and the highest court is the Supreme Court. So that is the court that has to make decisions about whether or not certain things would be considered constitutional. And at that point in our history, there was a lot of discussion and debate about whether or not we should have a federal income tax. So the Supreme Court ruled it unconstitutional. But then, of course, that changed with the passage of the 16th Amendment to the Constitution. And of course, most people realize that the Constitution was written in such a way that it left open the possibility of changes or amendments, and that has been done several times throughout the years. And it was that 16th Amendment that allowed that passage of a federal income tax. The next thing I want to talk about is a little bit about the purpose of taxes. And of course, this gets us into a philosophical debate, something that different people would have different opinions about. And of course, the main purpose of the course that you're taking is really to understand the actual facilitation of the income tax and how to do the calculations. But it doesn't hurt to just mention or at least discuss some of the main purposes behind the income tax. And of course, some people agree with it, some people don't. But the idea is that we all in some way benefit somewhat from various government services. And of course, that benefit could be both a direct or an indirect benefit. So for example, if we go to the store and we have a sickness or an illness and we purchase a medication, we would benefit from the fact that there's a Federal Drug Administrative Association that tests these medications to make sure that they're fit and that they're safe to be used. If we go out and eat at our local restaurant, we benefit from the fact that we have a health inspection service that is run by the local and state governments that checks the restaurants to make sure that the food is fit for consumption. When we get out on the highway, we drive to work or we travel from place to place, we benefit from the fact that there's a federal interstate highway system. So there are many things that we might or may not benefit from in a direct way or maybe even in an indirect way. And of course, we can't all receive itemized statements from the government that would charge us for just the services that we used or just the things that we benefited from. That would be impractical. So that's one of the purposes behind the income tax, that we all simply have to pay the tax because we all, in various ways that are very difficult to calculate and quantify, we would all benefit from these services. Now, in order to do some of our preliminary calculations, we need to talk a little bit about the terminology and also how we would actually determine certain items of income. And the first term that you see here is one called total income. And the IRS defines total income in a very broad way. They actually define it as income from whatever source derived. So when most of us think about income, we have a tendency to think about our job, salary, hourly wages, things like that. But there are actually many different sources of income, and all of those would be added together into our total income. In fact, we'll have some lessons later on in the course in future modules where we will literally talk specifically about certain items that are included in income. But then you have something here called exclusions. and this follows the income. And exclusions, these are certain specific items that have been identified by the IRS as being excluded from income. So that's where we would actually deduct those exclusions. And once we deduct those exclusions, that would equal a number that we refer to as the gross income. And then, of course, we would have the deductions. And there are certain items that have been identified by the IRS as deductions, and we'll actually have modules later on where we talk about specifically what those deductions are. But those would then be deducted from the gross income, and then that would give us the taxable income. And I know when you see these terms, it does seem a bit redundant to have a total income, a gross income, and a taxable income. But those are actually three different things, three different numbers. And of course, depending upon the answers that we get for those numbers, it will have an effect on our calculations and even some of the rules and whether or not we qualify for certain options. So that's why we have that structure there in place to help us determine what that taxable income is. And then once we have the taxable income, we can then determine the actual amount of taxes due or possibility of a refund. And of course, to do this, we would start off with the taxable income, which we had calculated from the previous criteria, and then we would take that taxable income and multiply that by the applicable tax rate. And we'll see in one of our later problem demonstration videos how to do that. And that would equal the tax before credits. Then we would deduct any tax credits, and of course there are many of those that we may or may not qualify for, and then that would equal the tax liability. But the tax liability, that is simply a preemptive amount. That's not necessarily the final amount that we will pay, because then we have one more thing to consider, and that would be the prepayments, because we have prepayments that are being taken place all throughout the year to the IRS when we have the money deducted from our paycheck. So if we deduct those prepayments, we would either have a positive or a negative answer. If we have a positive answer, then that means we still have taxes that are due. But if we receive a negative answer from that calculation, that means we are entitled to a tax refund. And eventually, we will go through all these calculations as part of a problem demonstration, but this just gives us a criteria that we could follow to keep ourselves organized when we do those calculations. The next thing I want to talk about are the different types of taxes. And I admit that in this particular course, we're going to focus almost exclusively on the federal income tax. But it's worth mentioning that there are a lot of other types of taxes as well. There's also at least the potential for a state income tax. Now, not every state levies an income tax, only certain ones. But if you happen to live in a state that does levy a state income tax, then of course you would have to prepare that return as well. And then you could also potentially have a local income tax. And that exists in certain areas, certain counties, and certain cities that levy a tax upon income. But again, not all cities do that, but all those are possibilities. Then you have the estate tax. And we're going to see later on how to calculate the amount of estate that you would have to pay the taxes on. And then, of course, we have the property tax. And that is assessed in many areas, and it's based upon the value of property. And then finally, we would have a sales tax. And the sales tax, that also varies from state to state. It could be a fairly low percentage, or it could be a fairly high percentage. It really just depends upon the state. And generally, states that do not have a state income tax will usually have a fairly high percentage sales tax as a way of making up for that. Now, when we talked about the different types of taxes, one of them was the estate tax. So now we're going to look in a little bit more detail at the estate tax. And of course, when someone passes away, if they leave behind an estate, the question then arises, how much of that estate will they have to pay taxes on, and how much will that be? So there's a criteria that can be followed that will enable us to figure out the taxable estate. And the way we would do that is we would start off with the gross estate, which is simply the entire value of the estate itself. And this would include, property, homes, vehicles, financial resources, investments, literally everything in the total estate. That would be the gross estate. And then we would have a series of deductions. And the IRS allows us to reduce that amount by deducting various items. For example, all the funeral and administrative expenses, we would get to deduct that. All the debts that have to be paid out of the estate. Any charitable contributions that would be made by the estate. And also a marital transfer, so that the person who passes away could potentially transfer these assets to their spouse. And that would all be deducted, and that would all be tax-free. So after deducting all of those items, what we would have left would be the actual taxable estate, or the portion of the estate that we would actually calculate the taxes on. And then we would have an addition there, any taxable gifts that were made after 1976. That would then give us a tax base, and that tax base would then be multiplied by the tax rates for an estate. That would give the tentative or the preemptive tax, and then after deducting the credits, you would finally have the actual amount of estate tax due. To be honest, you usually do not have to worry about the estate tax unless you have a fairly significant estate, because if you look at the rates as they currently stand, it's an estate valued at quite a few $1 million before this tax would kick in. Next thing I want to talk about very briefly are some of the objectives of taxes. And earlier we talked about the purpose of it, but then of course in the design and the implementation of taxes, what are the objectives? What are the things that we are trying to achieve? And they fall into two categories. And of course, one category is economic, and that is simply raising money through the tax to pay for services that are provided by the government. But a second objective, which is perhaps not as widely known or widely thought about, are social objectives. And as we proceed through the course and as we go through the various modules, I think you'll find that there are a lot of areas in the IRS code that are designed to achieve social objectives. For example, why does the IRS allow a deduction for mortgage interest? Well, that's a social objective, to encourage more people to purchase a home. Why does the IRS allow a person to deduct, in certain instances, scholarships that they receive? Well, that's a social objective to encourage people to go to college. So there are many different things in the tax code that are there for social reasons, to encourage certain types of social behavior.